Taxation income. We're going to take a look at both dividends as well as interest. Now, dividends can be paid in either cash or stock, and we're going to take a look at both scenarios here. Now, cash dividends are taxable as income. One exception that you should be very well aware of, because you'll probably see this on the test, is the corporate dividend exclusion. Now, when corporations invest in other corporations and they get paid a dividend, the corporate dividend exclusion will allow these corporate investors to exclude certain amounts from their taxable income. And the rule is that a corporation which owns less than 20% of the issuer's stock can exclude 70% of their dividend income. A corporation which owns 20% or more of the issuer can exclude 80% of the dividends received from this issuer. Now, questions regarding to this situation will usually indicate the percentage of stock owned, and a simple chart will help you to remember this. Now, if you look at the illustration in the book, I want you to note the less than sign and the greater than or equal to sign. That is, less than 20% is a 70% exclusion. Equal to 20% or greater is equal to an 80% exclusion. I'll give you an example. XYZ Corporation owns 2,000 shares of ABC Corporation, which is less than 20% of the company, and they receive dividends of $3,000. What is the dividend amount that is subject to taxes? Now, since XYZ owns less than 20%, the amount excluded from taxes would be 70% times the $3,000 equals $2,100. That's excluded. Now, the remaining $900 would be subject to tax. Now, another thing you should note for the exam, which comes up from time to time, if a corporation is given the option to purchase preferred stock or common stock, corporations will usually opt for preferred stock, and this is due to the typically higher dividend yields that are associated with preferred stock. Okay, stock dividends. Now, when a dividend is paid in the form of a stock, it's not a taxable event in and of itself. The additional shares are used to adjust the cost basis of the stock being held. And I'll give you an example here. Now, for example, an investor purchases 100 shares of ABC at a price of $33. His invested amount is $3,300. Now, if the investor receives a 10% stock dividend, he'll now own 110 shares of ABC. Now, dividing his investment of $3,300 by the 110 shares that he now owns is going to result in a new cost basis of $30. Now, if the position is subsequently sold for a price of $40, he'll realize a taxable gain of $10 per share. All right, interest income. Now, to determine the tax liability of interest income, you've got to analyze where that income came from. Now, in regards to federal income tax liability, the following is going to apply. U.S. territories and municipal bonds are tax exempt. That is, U.S. territories such as Puerto Rico, Guam, the U.S. Virgin Islands, it's triple tax exempt. Municipal bond income is tax exempt. Now, note for purposes of the exam, investors do not pay state or local taxes on bonds issued by the states in which they reside. As far as corporate bonds and government bonds are concerned, they are taxable. Easiest way to learn this is to look at an example. So, for example, let's say an investor in the 28% federal tax bracket and the 8% state tax bracket holds issues from all of the issuers above, a U.S. territory, a muni bond, a corporate bond, as well as a government bond. Now, the municipal bond was issued by the state in which the investor resides. If the investor received $500 income from each issuer, the tax applicable would be as follows. Now, on the U.S. territory bond, Puerto Rico, Guam, U.S. Virgin Islands, they're triple tax exempt. There's going to be zero tax liability. On the municipal bond, we said that the bond was issued by the state in which the investor resides. Therefore, we've got federal tax exemption, and we've got state tax exemption, which equals a zero tax due there. Now, the corporate bond, that's going to be fully taxable at the federal and state level. So you would take the $500 times the 28%, plus the $500 times 8%, gives us $180. Now, the government bond, we've got $500 times the 28% federal tax bracket, which is $140. Add them all up, we've got $320. Original issue discount bonds. Now, original issue discount bonds are sometimes referred to as zero coupon bonds or deep discount bonds. They're issued at a discount from face value, and they're redeemed at face value upon maturity. Now, this growth in value from the original discounted price to the face value is considered interest. Now, due to this fact, it's taxed as interest and not as a capital gain. Now, furthermore, if a zero coupon bond is issued by a municipality, the interest will be tax-free. Now, if an OID bond is issued by a corporation or the U.S. Treasury, the accrued interest would be subject to taxation each year, even though the investor has not received the interest in hand.